A CCPC earns $90,000 of passive investment income. Question: how much of its $500,000 small business limit just disappeared? If you can't answer that in 10 seconds, stay with me. This is one of the highest frequency tax calculations on the CFE, and I'll make it automatic. In the next few minutes, you'll be able to do 5 things. State the $500,000 business limit and where it comes from. Apply the passive income grind. $5 of limit lost for every dollar of investment income over $50,000. Avoid the number 1 trap, which is the year that income is measured in. Handle the second grind that hits larger corporations. And, the part that actually earns you marks, state the planning point, not just the number. Let's build it.
Start with the full limit. $500,000. This is the federal business limit under Section 125. Active business income up to this limit is taxed at the low small business rate instead of the general corporate rate. That's the whole reason the SBD matters. 3 things to lock in. 1. Only a Canadian-controlled private corporation, a CCPC, gets it. 2. It's shared among associated corporations, so a group splits one limit, not one each. 3. This $500,000 is then ground down by 2 separate rules. Those 2 grinds are the rest of this video. The first grind is triggered by passive income. Technically, Adjusted Aggregate Investment Income, or AAII. That's the corporation's passive earnings for the year. What counts? Interest income, taxable capital gains on passive assets, net rental income, and taxable portfolio dividends. What does not count? Active business income, gains on assets used in the active business, and most intercorporate dividends that are already deductible. Here's where the exam catches people. A capital gain on an asset used in the active business is excluded. If you throw every gain into AAII, your grind is wrong from the first line. Now the formula, memorize this one line. The reduction to your business limit equals $5 for every $1 of AAII above $50,000. 3 bands. If AAII is $50,000 or less, there's no grind. You keep the full $500,000. Between $50,000 and $150,000, you're in the straight line grind. $5 of limit gone per dollar over the floor. And at $150,000 of AAII, the reduction reaches $500,000 and your business limit is completely eliminated. 2 numbers to burn in. $50,000 is the floor. $150,000 is where it's gone. Let's answer the question we opened with. Our CCPC's AAII for the year is $90,000. Watch how fast this goes. First, the excess over the $50,000 floor. $90,000 minus $50,000 is $40,000. That $40,000 is the amount that gets ground. Now multiply that excess by 5. $40,000 times 5 is a $200,000 reduction to the business limit. That 5 times multiplier is why passive income is so expensive inside a corporation. A modest amount of investment income wipes out a large chunk of your small business room. Apply it. 500,000 minus 200,000 equals 300,000. That's your answer. 90,000 of passive income grinds the limit down from 500,000 to 300,000. If you got that in 10 seconds, you're exam ready on the mechanics. Now the 2 things that separate a pass from a miss. Trap number 1. And it's the one markers love. The grind on this year's business limit uses the AAII of the preceding taxation year, not the current year. Read that again on a case. When you're solving for the current year, you pull passive income from the prior year's figures. Miss this and everything downstream. The tax at the low rate, the general rate income, your integration numbers, is wrong, and it cascades. So state the year explicitly in your answer. Based on prior year AAII of X. That sentence earns the mark. The second grind has nothing to do with passive income. It's about size. It's based on taxable capital employed in Canada. Below $10 million, no capital grind. Between 10 and 50 million, the limit reduces on a straight line. Roughly $1 of limit for every $80 of capital over 10 million. At 50 million, the business limit is fully eliminated. One update worth knowing: the 2022 federal budget widened this band. The top of the range moved from 15 million up to 50 million, which actually gives growing companies more room than the old rule. Trap number 2. And this is where easy marks disappear. When both grinds apply, you do not add them together. You compute each one separately, then reduce the business limit by the greater of the two. So, if the passive income grind is $200,000 and the taxable capital grind is $120,000, the reduction you apply is $200,000. The larger one, not $320,000. Stacking them is one of the most common wrong answers on this topic. Compute both, take the greater, move on. Last piece, and it's the one that lifts you from a computed number to demonstrated depth. On the exam, the number alone is the floor. Add the so what, a few levers to reduce AAII. Move passive assets out of the operating company into a holdco or held personally to lower the CCPC's investment income. Manage the timing of realizing passive gains so they land in a year where the grind bites less. Where it fits the client, shift returns out of AAII using tools like an individual pension plan or permanent insurance, and always watch associated companies because one corporation's passive income grinds the whole group's shared limit. You don't need all four. Naming one relevant lever tied to the client's facts is what earns depth in tax. 30-second recap. $500,000 limit. Grind it by $5 for every dollar of AAII over $50,000. It's gone at $150. Use the prior year's AAII. And when the capital grind also applies, take the greater of the two, never both. That's the whole topic. I've put a one-page formula sheet for this in the description. Grab it and drill it before exam day. Subscribe for one CFE tax concept every week, right up to exam. And tell me in the comments, which trap were you about to walk into? The measurement year or stacking the grinds? I read every one. See you in the next one.